And so when you're trading for short-term duration, then the news that's coming out or the news that's dominating the wires is the news that you're trading, right? So when you have positive flow, so just to give you an example, on Thursday, we were positive euro on this move over here. We took the 27.50 move up, and it was very, very easy to make 35 points. I basically traded with a 50-point stop on a 35-point target. We made 27.85 within like a couple of hours on a move here, right? Conversely, by the way, the day before we broke the 27.50 here, and we made a move. This was on the negative Italian option, and we made the move over here towards the 2,700 up to the downside. But here's the point: when on Friday morning, I was actually bullish euro pretty much all the way throughout here, thinking that this Mario Draghi situation was going to still resolve to the upside. The short covering was going to kick in. But we also had our shorts at 27. We had two trades, one at 28.50, one at 27.50. This never got triggered because obviously the euro started to move. And then once it broke at 27.50, it just felt like a knife, and we were able to make the money over here in a very nice fashion for yet another trade for the week. So my week this week, by just trading very short-term, trying to follow flow on a short-term basis, was very successful. We had 4 out of 4 trades. That's not a common week. I mean, obviously, you're not going to get 4 out of 4 trades continuously. But the proposition that I'm trying to tell you is that given the market the way it is, that it changes on a day-to-day basis, you either have to look at it on a very long-term basis on a major sort of a geopolitical long-term trend. Like, for example, right now, if you think the whole situation in the Eurozone will simply not resolve itself, then you got to be short here with like a stop at 135. You got to give yourself that much room to prove yourself over a long period of time if the euro goes down to 120. Or you trade intraday when the news of the moment has the greatest resonance. Because trying to anticipate the news from here, what happens here, is almost impossible these days, because this is what, we have change of pace back and forth so much that continuation is just incredibly difficult to achieve. And I think that's probably one of the biggest aspects of 2012. You either trade very short term or you trade very long term, but trading intermediate term is incredibly difficult. And this is true, I'm showing you the chart of euro, but we can look at the chart of the Aussie, which is different but similar in the same way that you have these big chops up and down. Everybody see the chart of the Aussie here? Right? We have these, for example, we have this big continuation move. You're super bullish the Aussie, boom. It comes in, it gets chopped out, and then now we break all the way to the downside. And it looks like right now, where's the Aussie? Oh, no, actually, and now today, this is another maddening thing, right? Today we're having the Aussie basically break to, here it is. After testing the lows earlier in the session, we're breaking up now up to the upside as we get short covering coming in. So you have this incredible amount of whipsaw action, and you either contain your risk to very short periods of time where, if you're wrong 50 points and you get to regroup very quickly and look for new opportunities, or you give yourself so much room that these kind of wiggles just pass you by. Otherwise, if you're trading on 100, 150 point stops, you basically, getting whipsawed here, I get long here, I get whipsawed, I get short here, I get whipsawed. That's the story of the trade. And the problem is that for every 3 or 4, maybe you're going to get trends once in a while, but for every trend you're going to pick up, you're going to have 4 or 5 stop outs. And clearly, the stop outs are just much more difficult to make up than the 1 or 2 big trend positions that you have. Now, Harley's making a good point. He's saying that huge stops are suicide financially. They are for a lot of different reasons if you don't practice them properly, right? The larger the stop, the smaller the position, right? And obviously, the larger the profit target. You can't have a 500-point stop and a 50-point target. I mean, that's idiotic. You have a 500-point stop, you got to have at least a 500-point target, maybe even a 700-point target to try to even out the books. Generally, you want to try to stay at about 1-to-1, even Steven, as much as possible on your positions. One thing I suggest, and this is something that I've suggested over and over again, is it's very important, I think, to segregate your trading, to have lots of different accounts. Because one of the biggest problems that most traders run into is they try to practice different trading methodologies in the same account. And you cannot do that. You cannot trade long-term in an account in which you're also scalping. Because what inevitably happens is you either turn your scalp trades into massive long-term trades because you just pull the stops, or you start taking very, very short-term profits on your long-term trades because you're commingling the funds. It is very, very valuable and important to have an account with more than one broker and more than one account with each broker. And generally, what I have is I have my flow trading accounts with one broker, and even there, I segregate it by currency pair. So I have one account that trades nothing but the euro dollar on flow.